Hello, my name is Troy Atkins, and I am the founder and owner of Atkins Capital Management. I want to talk to you today about the key housing events that have transpired in the U.S. during the second quarter of 2018. During the second quarter of this year, the 30th anniversary of the annual release of the State of the Nation's Housing Report by the Joint Center for Housing Studies of Harvard University provided a wealth of information, including a review of the housing trends over the last 30 years, the current state of the nation's housing activity, the current state of the nation's housing burden, and the future state of the nation's housing. In addition, the actions of the Federal Reserve as part of its Federal Open Market Committee operations were the primary topics of discussion. This movie presentation also provides an overview of the home price level for a select group of cities that make up the Atkins 60 City Home Price Index, and it provides a wealth of information for prospective homebuyers to use in order to make a prudent home purchase decision. This presentation was written, narrated, edited, produced, and published by Troy Atkins. I am the founder and owner of Atkins Capital Management. Atkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. Our company is not affiliated with any parties associated with the residential housing industry. Our mission is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 15 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, and more than 8 years of freelance financial writing experience. I am also the author of more than 25 published articles. For more information about my background, skills, and experience, please visit the Atkins Capital Management website. With this overview in mind, let me now turn your attention to the primary events that have transpired in the residential housing environment. For the second quarter of 2018, the 30th anniversary of the annual release of the State of the Nation's Housing Report by the Joint Center for Housing Studies of Harvard University provided a wealth of information pertaining to the residential housing environment. The following is a summary of the key trends in U.S. housing over the last 30 years. More than 40 million housing units have been built since 1988. The median age of homeowners increased from 50 in 1990 to 56 in 2016. The typical home today is larger and more likely to have air conditioning, multiple bathrooms, and other amenities. The share of smaller homes built each year fell from 50% in 1988 to 36% in 2000 to 22% in 2017. While high mortgage interest rates put the cost of homeownership out of reach for many people during the 1980s, homeownership rates among young adults in 2018 are even lower than in 1988 for the following reasons. First, soaring housing costs. Second, housing construction is considerably more expensive due to sharply higher costs for building materials and labor, coupled with limited productivity gains in the home building industry. Third, land prices have skyrocketed as population growth in metro areas has intensified demand for well-located sites. And finally, weak income growth among low and moderate income households. It is important to note that the real median income of households in the bottom quartile increased only 3% between 1988 and 2016, while the median income among young adults in the key 25 to 34-year-old age group was up just 5%. Overall, in 1988, with historically high homeownership costs, the national home price-to-income ratio was 3.2, with just one metro posting a ratio above 6. In comparison, in 2017, the national price-to-income ratio stood at 4.2, and 22 metros had ratios above 6. However, a key finding of this report is that the low interest rate environment has kept the median monthly payments on a modest home lower in real terms than in 1988. Measured in real terms, home price increases since 2000 have been especially steep in the nation's 10 highest cost metros, including Boston, New York, San Francisco, and Seattle, where appreciation was an astounding 67%. In contrast, prices in the 10 lowest cost metros, including Dayton, El Paso, Memphis, and Syracuse, were up just 3% in real terms over this period. Between 1990 and 2016, the aging of the baby boomers pushed up the number of homeowners in their 50s by 75% and the number in their 60s by 63%. In combination with lower homeownership rates among younger households, these trends mean that the share of homeowners aged 65 and over increased from 1 in 4 in 1990 to 1 in 3 in 2016. The rate at which U.S. households change residences has been declining for many years, likely due to the increase in the number of homeowners that are older than 65. In 2017, 11% of the population moved to different homes within the preceding 12 months, down from 12% 5 years earlier and 13% in 2007. In terms of nationality, it is important to note that the number of foreign-born households more than doubled from 7.7 million in 1990 to 17.8 million in 2016. Foreign-born households accounted for more than 33% of the growth in households from 1990 through 2016. In terms of aggregate homeowners' credit quality, the median credit score for new mortgage originations was 755 in the fourth quarter of 2017 and has remained between 750 and 765 since late 2013. This range is significantly higher than the 720 averaged in 1999 through 2006. With this overview of the housing trends over the last 30 years, here is a summary of the state of the nation's housing activity as captured by the Joint Center for Housing Studies of Harvard University. In 2017, the national homeownership rate ticked up for the first time in 13 years. The total number of homeowner households hit an all-time high of 76.2 million. In 2016, the national homeownership rate reached a floor in the second quarter, after more than a decade of decline. In 2016, the national home ownership rate was 62.9%, which was at a 50-year low. In 2017, the national home ownership rate was 64.2%, which was in line with rates in the late 1980s and mid-1990s. The median price of an existing home rose from $237,387 in 2016 to $238,800 in 2017. In 2017, 6.1 million housing units were sold. In comparison, in 2016, more than 6 million housing units were sold. Constrained by limited inventory, growth in home sales slowed from 4.5% in 2016 to only 1.9% in 2017. Calendar year 2017 was the 10th consecutive year that homeowner outlays exceeded spending on single-family construction. Total housing starts edged up from 1.17 million units in 2016 to 1.2 million units in 2017. In 2017, single-family starts stood at just 849,000 units, well below the long-run annual average of 1.1 million units. From 2008 through 2017, 610,000 single-family homes were added to the housing stock on an annual basis. From 2016, new home sales rose 9.3% to 613,000 units. This was the sixth straight year of growth from the 5-decade low of 306,000 units in 2011. More than half of new home sales were in the South, and about a quarter were in the West. Of the remaining sales, 12% were in the Midwest and only 7% in the Northeast. The median price for a small home sold in 2016 was $191,700. The median price for all other single-family homes was $324,700 in 2016. With this overview of the state of the nation's housing activity, here is a summary of the state of the nation's housing burden, as captured by the Joint Center for Housing Studies of Harvard University. More than 38 million U.S. households have housing cost burdens. In 2016, nearly one-third of all U.S. households paid more than 30% of their incomes for housing. And some 38.1 million households spent more than 30% of their incomes on housing. While down by 800,000 from 2015 and by 4.6 million from the peak in 2010, the number of cost-burdened households was still some 6.5 million higher in 2016 than in 2001. Increases in the median sales price of existing homes have outstripped growth in median household income for 6 years. The price of a typical existing home sold in 2017 was more than 4 times the median income. Among the 100 largest metros, 33 had price-to-income ratios above 4, including 5 with ratios above 8. A key recommendation of this analysis is that prospective homebuyers need to assess the positive impact that the current low interest rate environment is having on their home purchase opportunities by using the Atkins Residential Home Valuation Analyzer. By the end of 2017, nominal home prices in 59 of the nation's 100 largest markets exceeded their pre-crisis peaks. Although the share of cost-burdened owners is considerably lower at 23%, their numbers still total 17.3 million and include 7.5 million with severe burdens. At the end of 2017, the share of loans in foreclosure was 1.2%, in line with pre-crash levels. The share of loans in foreclosure peaked in the fourth quarter of 2010 at 4.6%. The number of owners underwater on their mortgages shrank from more than 12.1 million in 2011 to 2.5 million in 2017. The share of mortgaged residential properties with negative equity had receded to 4.9% at the end of 2017, down sharply from 26% at the end of 2009. Negative equity should no longer be a significant drag on sales. On an even more positive note, in 2016, 28% of homeowners had mortgages with fixed interest rates of 4% or lower. However, to the extent that interest rates increase significantly, this group may have an incentive to stay in their current homes, further limiting the for-sale housing inventory. The 16 major disaster events in 2017 caused a record-setting $306 billion in damages. These events caused the destruction of hundreds of thousands of homes and widespread displacement of households across California, Florida, Puerto Rico, and Texas. In Puerto Rico alone, storms destroyed or severely damaged an estimated 472,000 housing units. With this overview of the state of the nation's housing burden, here is a summary of the future state of the nation's housing, as anticipated by the Joint Center for Housing Studies of Harvard University. The choice between owning and renting will depend on a variety of factors, including relative costs, expected length of stay, tolerance for financial risk, and the perceived benefits of each option. Home ownership will likely be constrained by rising home prices, affordability challenges, outstanding student loan debt, and a limited inventory of homes for sale. A rising interest rate environment will worsen the affordability pressure facing potential home buyers. The average age of homeowners will continue to increase. By 2035, 1 out of every 3 households will be at least 65 years old. Since older people are less likely to move, existing housing inventory for sale will likely be minimal. The supply of new housing will face significant challenges due to labor shortages, rising materials costs, limited land availability, and land use regulations. With inventories of existing homes for sale expected to remain low, upward pressure on home prices will make home buying more difficult, especially for low and moderate income households. Immigrants will increasingly drive household growth, especially after 2025, when native-born population growth is expected to decelerate further. The rising incidence and intensity of natural disasters will pose new threats to the housing stocks of entire communities. Moving away from these policy issues and events and to an assessment of the mortgage lending environment, it is important to note that for the second quarter of 2018, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan began the quarter at 4.54% and ended the quarter at 4.66%. For the first time since June of 2011, the national average mortgage loan interest rate for a 30-year fixed-rate loan exceeded 4.61%. In order to better assess the current mortgage loan interest rate environment, prospective homebuyers should remember that the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan reached an all-time low of 3.31% in November of 2012, and it reached an all-time high of 18.63% in October of 1981. In view of realized and expected labor market conditions and inflation, the Federal Reserve elected to raise the range for the target federal funds rate by 25 basis points, from a range of 1.5% and 1.75% to 1.75% and 2% during their Q2 2018 Federal Open Market Committee operations meeting. Prospective homebuyers should closely follow the level of mortgage loan interest rates in their community, because a rising cost of debt will increase the amount of interest expense that prospective homebuyers will need to pay for their mortgage loan. This in turn will place downward pressure on the price level of residential housing in their community. Prospective homebuyers should use the Atkins Residential Home Valuation Analyser in order to assess the impact of a changing interest rate environment. Now that I have provided an overview of the events and trends that have taken place in the residential housing environment for the quarter, let me turn your attention to the proprietary finance-based analytical methodology and cloud-based residential real estate analysis software application that you can use in order to provide an assessment of the price level of homes in your community. The Atkins Residential Home Valuation Analyzer is an internet-based software application that analyzes the relationship between the median home price level for a city and the median household income level for the city. With this information, the software application takes into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan, and the assumption that no more than 28% of pre-tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the Atkins Residential Home Valuation Analyzer can accurately assess the price level of homes in your city. From the first analytical perspective, the Atkins Residential Home Valuation Analyzer determines the level of underpricing or overpricing of homes in your city by calculating the mortgage loan interest rate that justifies the price level of homes in your city. With this information, the justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately assess the level of underpricing or overpricing of homes in your city. From the second analytical perspective, the Atkins Residential Home Valuation Analyzer calculates the percentage of household income that would have to be spent by the people that live in your city in order to justify the price level of homes in your city. With this information, the justified percentage of household income amount is compared against the traditionally accepted household income amount of 28% in order to accurately assess the level of underpricing or overpricing of homes in your city. By utilizing the Atkins Residential Home Valuation Analyzer, you can determine the level of underpricing or overpricing of homes in your community, as well as the magnitude of underpricing or overpricing of a specific home that you are considering to purchase. This in turn will help you make a prudent home purchase decision. For more information about our finance-based analytical methodology and the use of the Atkins Residential Home Valuation Analyzer, please review our finance-based analytical methodology report on the Atkins Capital Management website and watch the wealth of movie presentations that provide an overview of the Atkins Residential Home Valuation Analyzer. For the second quarter of 2018, 19 cities that make up the Atkins 60 City Home Price Index were classified as overpriced for the quarter. San Francisco, Honolulu, Newark, San Diego, and Bridgeport were identified as the 5 most overpriced cities in the index. While San Francisco, Honolulu, and Newark, and San Diego and Bridgeport had the same justified percentage of household income amounts, San Francisco and San Diego were classified as the most overpriced city in their respective category due to their higher required median household income levels. In terms of a relative price level analysis, it is not possible to justify the home price level for the top 5 overpriced cities by reducing the 30-year fixed-rate mortgage loan interest rate from 4.66% to 0%. Therefore, in order to classify the homes in the top 5 overpriced cities as underpriced, it would need to be deemed prudent by prospective homebuyers to spend more than the justified percentage of household income amount. As an alternative, in order to justify the median home price level for each city, the median required household income level would need to increase to a level within the respective range of $75,821 and $180,105. Finally, based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, the justified home price level for the top 5 overpriced cities fell within the respective range of $162,666 and $380,837. Prospective homebuyers can use the Atkins Residential Home Valuation Analyzer in order to assess the price level of homes in their community. On the other side of the spectrum, 31 cities that make up the Atkins 60 City Home Price Index were classified as underpriced for the second quarter of this year. Detroit, Buffalo, and Wichita were classified as the top 3 underpriced cities in the index. Cleveland, Huntington, and Portland followed suit and were ranked according to their justified mortgage loan interest rate amount, because interest rates would have to reach these levels before these cities would be classified as overpriced. In order to classify homes in the top 5 underpriced cities as overpriced, the national average mortgage loan interest rate would have to increase from 4.66% to more than the justified mortgage loan interest rate amount for each city, or it would have to be deemed imprudent by prospective homebuyers to spend as much as the justified percentage of household income amount in order to repay the costs of a mortgage loan. Prospective homebuyers can use the Atkins Residential Home Valuation Analyzer in order to assess the price level of homes in their community. Given the recent events that have transpired in the residential housing market, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to analyze residential real estate from 5 financial perspectives. First, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess the level of underpricing or overpricing of homes in their community. Second, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess the largest amount of money they should spend in order to purchase a home. Third, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess the amount of money they would need to earn on an annual basis in order to be able to afford to purchase a specific home. Fourth, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess total home ownership costs expressed as a percentage of household income. And fifth, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess how much a home would need to appreciate in value each year in order to offset the costs associated with owning the home. By assessing residential real estate in this manner, prospective homebuyers will be able to make a prudent home purchase decision. For more information about the Atkins 60 City Home Price Index, to watch our catalog of residential housing movie presentations, or to subscribe to use the Atkins Residential Home Valuation Analyzer, please visit the Atkins Capital Management website at residentialrealestateanalysis.com. This is Troy Atkins, saying thank you for taking the time to listen to this presentation.